Something has snapped in the Canadian economy, and you can see it most clearly in housing. Sales have collapsed, inventory is piling up, construction is stopping, and the market isn't just cooling, it's freezing in a way that we haven't seen in decades. This isn't a normal cycle. This isn't seasonal, and it's not just about interest rates. What's happening in Canadian real estate right now is a visible symptom of something much larger that's happening. Capital is leaving the country, and once you understand that, the last 2 years start to make a lot more sense. To make sure you're paying attention to our real estate market and keeping up to date, hit that subscribe button below. Let's start with the hard numbers. In January of 2026, sales in Vancouver were down 29% year over year. And that context matters here because last year wasn't exactly a boom to begin with. It was already soft. We are sitting at the lowest sales volumes in roughly 25 years. Think about that for a second. The population of Metro Vancouver has grown by nearly 1 million people since the 1990s. Yet the number of people actually buying homes has dropped to levels we saw way back then. The market hasn't just slowed, it's stopped functioning. Toronto is telling the same story, and to a worse degree. Sales there are the worst since the 08-09 financial crisis. And prices are down roughly 27% from the peak in 2022. Normally, when buyers pull back, sellers do too. Listings come off the market, people wait it out, and you get an orderly downturn. That is not what's happening right now. Inventory is surging. In Vancouver last month, active listings hit a 16-year high. So now you have a 25-year low demand colliding with a 16-year high in supply. That collision shows up clearly in a metric that you should always keep your eye on, and it's the sales to active listings ratio. Anything below 12% is considered a buyer's market. Right now, that ratio is sitting at about 9%. That means out of every 100 homes listed, 9 of them actually end up selling. We're going to need to see at least 3 months of that to actually call it a trend, but ratios like that are changing psychology quick. A year ago, sellers were stubborn. I know what I've got and I'll wait. Now, they're bargaining in the other direction. To get a showing, not even a sale, just to get someone through the door, we've seen some listings drop their list price by $100,000 to $150,000. Depending on the price point, that's a 5 to 8% cut immediately. That isn't panic selling. That's price discovery happening in real time. And yes, some people will say prices have been too insane for too long, and fair enough. But housing in Canada isn't just about a place to live. It's the engine of the domestic economy. When sales volumes drop by 30%, governments collect 30% less in property transfer tax. They collect less in GST because new builds aren't selling. That money funds schools, hospitals, and infrastructure. It can also drain liquidity out of small businesses. A large number of entrepreneurs rely on home equity line of credits to make payroll or buy inventory. When home values fall, banks freeze those lines. When that line freezes, the business stalls. It's a domino effect. Now, let's take a look into the future. If the resale market is bad, what does the construction pipeline look like? Well, to put it bluntly, the future has effectively been canceled. 2025 was already a constrained year for launches, and the outlook for 2026 is basically zero growth. Project launches are down 60% compared to the 10-year average. And if you focus specifically on concrete high-rise towers, the ones that define our skyline, that number jumps to over 75%. They're almost non-existent. Because of construction costs, labor shortages, and layers of government's fees and taxes, a brand new presale condo costs about 21% more than existing condo you can buy down the street today. As an investor, you're being asked to pay a premium, take 4 years of completion risk, and accept uncertain rent numbers when you could buy something down the street today for much cheaper and rent it out. It just doesn't make a ton of sense right now. And that's why the investor class, which typically buys up a large number of units in these pre-sale projects, has effectively disappeared altogether. And because banks require roughly 60% pre-sales before they'll finance construction, no pre-sales means no financing, and no financing means nothing gets built. Developers are pivoting to wood frame buildings, multiplexes, and townhouses, because that's the only thing that end users could potentially afford right now and also actually want to live in. But that creates a new problem. We are borrowing a massive supply crisis from the future. For years, the counter-argument was simple. Don't worry about supply, demand is infinite because everyone wants to live in British Columbia. In the third quarter of 2025, That rule broke. BC recorded a population decline of roughly 14,000 people, the first decline on record. People are now actually leaving. And it's a combination of two forces. Federal policy changes sharply reduced the number of non-PRs, like international students and temporary workers. And at the same time, interprovincial migration turned negative. People are looking at the cost of living in BC, comparing it to Alberta or the Maritimes, and saying, I just can't make this work anymore. So now you have a surge of rental supply completing from projects started years ago, hitting the market at the exact same time that population is shrinking. Supply up, demand down. Economics 101. Rental inventory increased about 66% above the 10-year average, and rents are flattening. The allowable rent increase in BC was capped at 3%, and yet the market only grew by 2%. That tells you that landlords aren't even taking the full legal increase because they're scared of vacancies. So if you bought a condo as an investment, your asset value is falling 5% or more, and your rental income is flatlining. The math just doesn't work anymore. And that's why the capital flight we're seeing isn't just big corporations. It's individual investors realizing that putting their money somewhere else is better than investing in the Canadian real estate market. Now, let's zoom out. At the same time all of this is happening, Prime Minister Mark Carney was at the World Economic Forum standing on a global stage and pitching Canada as a safe harbor. The idea that in a world on fire, Canada is the boring, stable place to put your billions. Stability is the brand as it always has been. But when you look at the numbers, they tell a very different story. As of 2024, Canada's net foreign direct investment position is negative $1 trillion. To put it simply, that means Canadian companies and pension funds have invested $1 trillion more abroad than the rest of the world has invested here. That is a staggering vote of no confidence. While Carney is asking the world to invest in Canada, our own pension funds, the people managing our retirement savings, have already sent that money elsewhere. When CPP or teachers' pension funds look at a map, they're deciding that building a toll road in Texas or a wind farm in Europe offers a better, safer return than building anything in Canada. And that decision flows directly into your day-to-day life. Capital determines productivity. The machinery, software, and tools people use to do their jobs are what economists call capital stock. In Canada, the stock of machinery and equipment has declined about 4.6% over the last decade. In a world obsessed with technology, Canadian businesses are operating with less equipment that they had 10 years ago. You could not be more productive with outdated tools. And if workers aren't more productive, employers physically can't increase their wages without going bankrupt. Since 2014, investment per worker in the United States rose by more than 26%. In Canada, it fell by about 16%. And it's not just heavy machinery. Amazon alone spends nearly 3 times more on research and development than the entire Canadian business sector. So why is all of this happening at once? The common denominator, which I touched on at the start of the year, is uncertainty. Capital hates uncertainty, and Canada has become very difficult to predict. The Prince Rupert Port Authority is another example of that. You had Dutch and Canadian capital trying to build a multi-billion-dollar gas export terminal. The project followed the rules as they were written at the time. It received Crown approvals and signed benefit agreements with the First Nations. And then years later, the Metlakatla First Nation sued the Port Authority over an export monopoly, arguing that they weren't consulted on that specific issue. And a judge recently cleared the path for that lawsuit to proceed. I'm not going to get into the legal merits of that claim here. I might go into that in a separate video in the future. But look at it through the eyes of the global investor. They see a massive project that was supposedly approved, now potentially stuck in legal limbo for years. Prince Rupert moves about $60 billion in cargo annually and is Canada's shortest route to Asia. But if investors view it as a legal minefield, they either add massive risk premium or they go somewhere else. And can you really blame them when there's legal uncertainty from land claims, tariffs from the US, and on top of that, already high taxes? And that brings us full circle to the Prime Minister's safe harbor pitch. He's selling stability, but investors see policy flip-flops. Capital gains tax changes that came out of nowhere, sudden immigration targets cut after years of expansive growth. The rules seem to change every quarter. And as an investor, if you can't predict the rules of the game, you just don't play. And in BC with David Eby at the reign, that policy flip-flop is amplified even more, which I'll get into in my next video. What we're seeing right now is a repricing of Canada. The cost of doing business, the value of our homes, and the price of risk are all adjusting downward, and capital is leaving because of it. If you're a seller waiting for a return to 2022 prices in the next couple of months, you need to take a harder look at the structural data. This isn't a seasonal dip. With a population declining and capital leaving, the market is punishing pricing and marketing errors brutally. Your listing photos matter. Your list price matters a lot. And on top of all of that, the marketing strategy behind both of those matters even more. So make sure you're working with a professional, and most of all, someone you trust. If you're a business owner or contractor, I would say embrace for a sluggish 2026. Construction is a massive employer. When housing starts collapse, the ripple effects tend to spread everywhere. For a long time, Canada relied heavily on two growth engines: resource development and real estate. That worked when capital was abundant, population growth was predictable, and financing was cheap. What we're seeing now isn't the end of real estate, it's a reset. Prices are being forced to reconnect with incomes, financing costs, and actual end user demand. Real estate doesn't disappear in that environment, it just stops becoming a one-way trade. The current market we're in isn't one that rewards denial. It's a market that rewards preparation, flexibility, and clear-eyed decision-making. The era of set and forget is over. The era of thinking markets is back. If you want to understand how this affects your specific situation and what strategy you should adopt, there's a Calendly link below. I'd be happy to go over it with you.